let's talk about Chapter 13 in general before we carry on with 13.3 here. We have looked at 4 objectives of analyzing financial statements, and Section 13.1 was all about the financial strength ratios, short-term and long-term. Then Section 2, we looked at profitability ratios, and a lot of them related to that. This third section is going to be about efficiency measures and market ratios. So those are our 4. And remember that when we're analyzing, 3 things have to happen. We have to calculate some relationship of numbers on a financial statement. Then we have to set a target or a standard to determine whether or not things are going good or bad. And then thirdly, we have to say what action is required to improve, maintain, change, do something to that ratio as a business. So don't forget to use your Blackline Masters for your notes on all of these as we start to go into this chapter section. So first is analyzing efficiency, and we have to utilize our assets well in order to drive growth and profitability for a business. And in a merchandising business, there are really 3 things that happen usually. We purchase merchandise, we sell merchandise, sometimes on account, sometimes for cash. If it's on account, we want to collect that accounts receivable as fast as possible. So we often offer accounts receivable in order to try to encourage sales and increase them. But we have to collect those receivables then if we do that, and the quicker we do that, the better. So speed is a big deal here. So we're going to look at 2 different calculations. One is the AR turnover. So the AR turnover ratio, you can see, is the number of times the average amount of AR is collected during a specified period, and we typically look at a year. And again, it's monitoring what our collection efficiency is like. So if you look at the actual calculation of AR turnover, you'll notice that to do average value of AR, we take the beginning and the ending, which both come from your balance sheet, to come up with what the average was for the entire year. And then we take net sales, which comes from the income statement, and divide it by that average book value of AR to get AR turnover ratio. Just one last reminder, do not forget book value is accounts receivable minus the allowance for collectible accounts. So when we've done this whole calculation, we get 10.6. And that 10.6 means that accounts are being collected 10.6 times per year. And we need to determine whether or not that's good or bad. But in accounts receivable, it's usually better to dig a little deeper and to look at something we call days sales in accounts receivable. So that is the average period of time to collect the AR. So how many days does it take? And we're going to look at this versus our credit policy. So if our credit policies are 210 net 30, that means that they had to pay the full amount within 30 days. So if it's day sales in AR of over 30 days, that's not good. That means our customers are taking longer than our credit terms allow. So we'll talk more about that as we see the calculation. So the calculation is pretty simple. It's taking 365 if you're looking at a year like we typically are, divide it by that AR turnover you just calculated of 10.6 times per year to get the number of days. So 34 days is what we get here. And for this particular company, Forrest, their credit policy state that it's net 30. So again, it's taking 34 days on average to collect receivables. That's not a good thing. That is pretty bad. So things that I need to do that I would make sure I had in my notes is actions I need to take are to review the credit terms. So this net 30, is that the right answer? Should I loosen them up? Is it really not that crucial I'm collecting that quickly, or do I need to collect quicker than that. And then if I do need 30 days, then I need to evaluate who's extending the credit to our customers, because that credit may not be appropriate for the customers that we have. So we need to get better customers that are more likely to pay. So that's some of the actions that we could take. So besides accounts receivable, inventory is typically one of the other large assets. So we're going to look at the exact same kind of measures for them: inventory turnover ratio and days inventory. So how are those computed? Again, speed is going to matter because we only earn income if we sell merchandise. So we have to manage that really well and try to get it sold as quickly as we can. So the inventory turnover ratio is the number of times the average amount of merchandise inventory is sold during a specific period, which again is typically 365 days. So the calculation very similar. We're looking at average inventory, so take January 1st and December 31st and average it out. We take the cost of merchandise. By the way, those were both from the balance sheet. Then we take the cost of merchandise sold from the income statement, divide it by that average to get the inventory turnover ratio. And again, 3.3 means the inventory is being sold 3.3 times per year, the average inventory. The day sales is the time needed to sell an average amount of merchandise inventory, so the number of days it's taking to get it sold. So again, we take 365 divided by 3.3, and we get 111 days. So here's what I would include in my notes as it relates to these two things: 3.3 inventory turnover and 111 days. Excuse me. So the optimum is determined by a couple things. The first thing I would care about is the amount of sales that I have. The second thing that I would care about is the number of days that I need to replenish the inventory. So if it takes me 150 days to get inventory items in because of the magnitude of them, where they're coming from, other things, this would not be quick enough for us. So for this company, Forrest, in the book, it talks about the standard is 3.3 to 3.6 on the inventory turnover ratio. And that means that they're right at the bottom of that range, so they're okay. They're not great, they're okay. Low inventory turnover is going to indicate that we have too much inventory on hand, meaning we're not turning it over and selling it quickly. So we have a lot of inventory sitting there that's not getting sold quick. If it's high, at the high end of the range, it means that we may have too little of inventory and we're possibly losing sales because of this, because we can't get stocked up again. So that's kind of how to evaluate those two.